What if I told you that going from $0 to $1 million is actually way harder than getting from $1 million to $10 million? Most people think hitting your first million is the part to celebrate. But the truth is, that's when wealth building finally gets easy. Here's a data point almost nobody talks about. Warren Buffett earned 99% of his fortune after age 56. Most of his real breakthrough came long after he was already rich. Let that sink in for a second. If you're still trying to hit that first million, every year you wait can cost you hundreds of thousands later. In the next 3 minutes, I'll break down the exact math, show you the 4 steps that trigger exponential growth, and reveal how everyday people are making the leap. This is Jim from Jim Invests, and after years studying the real numbers behind wealth acceleration, I can promise the system is rigged to reward those who endure the slow climb. Stay with me, and I'll show you how the game actually works. Let's start by exposing the biggest myth about building wealth. Most people picture wealth as a staircase. Save $1, move up a step. Save another, move up again. It's simple addition, right? But if you're mapping your financial future this way, you're actually setting yourself up for a lifetime of frustration. The truth, and this is proven not just by millionaires, but by actual math, is that wealth grows on an exponential curve, not in a straight line. That's why so many intelligent, hard-working people never break out of the paycheck-to-paycheck cycle, even after years of diligent saving. First, let's look at what exponential really means, using real numbers. Suppose you invest $500 every month consistently into a broadly diversified portfolio, averaging an 8% annual return. This isn't a lottery ticket. It's a totally realistic goal for a middle-class earner, focused on steady investing and keeping costs low. During the first few years, you might feel like your money's going nowhere. After year 1, you'll have contributed $6,000 of your own cash, and your account might have grown just a few $100s from investment returns. Here's where it gets real. To reach that first $1 million, you need to stick with those $500 deposits every single month for about 25 years. That's right, decades. And do you want to hear the most mind-blowing stat? Of that first million, roughly $150,000 is money you put in yourself. The other $850,000 comes purely from compounding over time, 85%. You're not winning because you saved harder, but because you finally crossed into the phase where your investments do most of the work. If you're wondering if this is just theory, let's make it visual. Imagine 2 bars on a chart, one for your contributions, one for returns. For years, your contributions bar towers over the returns. But after year 20, something wild happens. The returns bar starts multiplying, and by year 25, it absolutely dwarfs everything you put in yourself. If this calculation changes the way you see money, drop a mind-blown emoji in the comments. I want to know who just had a light bulb moment. Now, here's where most people's heads explode. Once you finally hit that 1 million, getting to 2 million happens twice as fast, with the same $500 per month and the same investment strategy. The next million lands in about 10 years instead of 25. No extra hustle, no magic tricks, just the brutal force of compounding on a big foundation. Let's zoom into that for a second. If you have $100,000 working at 8%, you'll make $8,000 in a year. Respectable, but not game-changing. Got $1 million invested? That's $80,000 a year, more than what most Americans earn from their day jobs. And if you're actively reinvesting those gains, the compounding accelerates. This is the turning point. Your money officially works harder than you do. So, how do you trigger this shift? Let me introduce the 4-step exponential wealth map. Each one carries you closer to the inflection point, where you move from slow grind to rapid acceleration. First, accumulate your first $100,000. Why 100,000? Because every dollar after the first 100,000 gets amplified more and more by returns. Think of it as buying your ticket to the compounding game. At 8% returns, $100,000 produces $8,000 a year without any new savings. That's your base engine. If you're under 100,000 right now, comment "breaking in" below so our community can support you on this crucial threshold. And no shame. Every millionaire started there. Second, reach the first $1 million. This is where it gets tough. The discipline to invest consistently, avoid lifestyle inflation, and minimize big mistakes is everything. During this time, the market's ups and downs will mess with your head. Here's a secret that will help you stick it out. Most of your wealth will appear too. Grow painfully, glacially slow until year 20 or so. Then suddenly, the numbers leap upward. If you skip this phase or bail out during a crash, you'll never see the real rewards. Let's illustrate this with a quick story. Take Sam, one of our subscribers, who emailed me last year. She started investing at age 24, putting away $400 a month, and stuck to it even while working retail. For a while, her portfolio seemed to crawl up by only a few dollars every month. But by age 39, her balance hit $100,000. 8 years later, she crossed $300,000, having contributed a total of about $72,000 and getting the rest, over $228,000 from market growth. The lesson: it's rarely fast, but it's almost always inevitable if you persist. And remember, this is educational only, not financial advice. Past performance does not guarantee future results. Consult a licensed financial advisor for your situation. Third, utilize leverage. And I don't just mean debt. This is where most people plateau, because they don't realize what's available once they cross that $1 million line. Wealth unlocks options: lower interest loans, access to private markets, real estate syndications, and business deals you didn't even know existed. Picture this. You have a $500,000 rental property with $200,000 left on the mortgage. The bank is now happy to refinance, handing you capital to buy a second property. Now you're getting income from two sources, both appreciating and both bringing tax advantages. Accumulate, reinvest, repeat. As your assets grow, so do these opportunities. A lot of viewers ask, isn't this risky? Of course, leverage amplifies both gains and losses, so you have to be disciplined and well-informed. That's why I always say, never leverage what you can't afford to pay off. And for anything involving investments, make sure to consult a licensed professional and understand all the risks. Fourth, compound your connections and expertise. At a certain point, financial capital lets you buy time, relationships, and access. The wealthy don't just invest in stocks and real estate. They invest in talent, advice, and deal flow. When you're broke, you do everything yourself. When you're wealthy, you pay people smarter than you to save or make you more money. The same tax strategy that saves someone with a $100,000 income $2,000 could save a millionaire $20,000. The same legal advice that prevents a $5,000 mistake for a starter investor could protect $500,000 for someone playing at a higher level. Even more important is information. When affluent people play golf or have dinner, they're sharing opportunities, referrals, and market insights. that rarely show up in the news. It's not illegal. It's just networking at a different scale. To join this game, you need to start locally. Join business or investor meetups. Ask smart questions and critical. Build trust by being reliable. The ripple effect can change your financial life faster than you expect. Let's check in. Which step are you currently on? Drop your number in the comments below. I read and reply to the first 50. Let's help each other make every step count. Between these steps, there's a common thread. Control over your time. When you're grinding for every paycheck, you're trading hours for dollars. But every dollar you build into investments returns your time back to you. Slowly at first, then rapidly. This is why high net worth people spend more time on strategy, learning, and relationships. Their money is working even when they're sleeping or on vacation. They're free to take calculated risks that would terrify someone without a safety net. They can leave jobs for new ventures or invest in new skills or markets, not out of desperation, but out of choice. Let me show you the Buffett principle in action. Warren Buffett was a millionaire by age 30, a huge accomplishment. But here's the catch. By the time he was 56, almost all of his net worth still lay ahead of him. 99% of his total fortune came after his 56th birthday. That's not because he got smarter. It's because the math of compounding worked for him at scale. If you ever see his net worth chart, it practically goes vertical after that inflection point. Between 1986 and 1989, Buffett's wealth soared from $1 billion to $3.6 billion. By 1995, it was $10.7 billion, and by 1999, $36 billion. Each new milestone took less and less time. The same logic works even at much smaller scales. If you're reading this thinking, I'll never have $1 billion, remember, the same compounding works whether you're aiming for 10,000, 100,000, or $1 million. It's the timing, persistence, reinvestment, and leverage that drives the curve upward. Now, there's a part of this pattern few people talk about. The psychological shift after. Reaching your first million is massive. Every investment decision before that mark feels loaded. Should I put my money here or there? Should I buy a house, stocks, or just keep cash? Each choice seems potentially catastrophic. But after $1 million, two breakthroughs happen. Helpful first, you can afford to take risks. A $10,000 bet is no longer terrifying. It's 1% of your net worth. Second, you gain access to VIP deals, private equity, hedge funds, real estate syndications that require $100,000 minimums and above average returns. Translation: the more wealth you build, the more tools and better deals you unlock. Let's touch on the catch-22. Most wealth advice is written for people with assets, but most people aren't there yet. So how do you leap the gap? Maximize your savings rate early on. Minimize debt that doesn't build assets. And focus on growing your income. Automate your investments so you can ride out the slow years without temptation to quit, play the long game, and keep increasing your contributions as your earnings grow. Even small increases compound faster than most people realize. And let's bust the most common myth. Millionaires are not smarter or luckier. They persevered through the boring, unglamorous stages until the math turned in their favor. They avoided liabilities masquerading as assets. That means the $500 car payment and oversized houses stayed off their books so they could keep accumulating capital. Are you finding this helpful? Screenshot the chart or framework you like best and share it with someone grinding toward their first $100,000 or $1 million. Chances are they need to see that the pain is temporary, but the payoff, if you stick with it, can be exponential. There's a reason banks treat millionaires differently. If you own $1 million in assets, lenders start offering you credit lines at rates barely above what they pay on savings accounts. Let's make this power move tangible. Suppose you want to buy a $400,000 rental property. The bank requires only $80,000 down, loaning you the rest at a low interest rate because of your asset base. If that property appreciates by just 5% per year, you're gaining $20,000 in paper wealth on your $80,000 investment, a 25% return. Not counting rental income or tax benefits. That is leverage done right. Again, remember, past performance does not guarantee future results. This is for educational purposes only. Now let's circle back to the rich get richer phenomenon. It's not just a saying, it's a mathematical outcome. Every new dollar added to your portfolio works harder than the last, thanks to access, deals, returns, and tax efficiency. When you're just starting, every dollar feels like a tiny contribution. Once you're on the other side, every year can deliver more wealth than your entire previous career. If you're not there yet, don't think the system is closed to you. Think of the early stage as buying your ticket to this leverage. By now, you might be wondering, what do I actually do this week? What tools can make the difference? Here's a simple, actionable plan. Today, calculate your average monthly savings and investment rate. Even $100 per month is a start. Automate it so you don't have to decide every time the paycheck comes in. This month, download the Exponential Wealth Calculator I've linked below. Plug in your numbers and see for yourself how small, consistent actions play out over years. Share your results in the comments. I'm always curious to see real projections. Next 90 days, increase your income or reduce spending by at least 5%. Every added dollar goes straight into your investments. The earlier you accelerate, the steeper your future wealth curve. 6 months to 1 year. Review your progress. Are you still on track toward that first 100,000 or million? Adjust your targets upward if you got a raise, side hustle, or unexpected windfall. This is not a set-it-and-forget-it path. It's meant to adapt as you grow. Final tip. Join a community. Wealth grows faster when you're surrounded by others on the same path. Comment below or join an in-person meetup. We all go further together. So, let's recap the 4 steps. First, accumulate your first $100,000. Second, build to your first million. Third, leverage your existing wealth for greater returns. Fourth, compound your connections and expertise. Each step you move forward, opportunities and returns grow exponentially. You're not just chasing numbers, you're building a flywheel that once in motion gets easier every year. If you're ready to see your own exponential timeline, download my free Exponential Wealth Calculator. Link in the description. It's the same template I give my private coaching clients. Punch in your numbers and watch your future net worth curve unfold. Remember, everything in this video is educational, not personal financial advice. Past performance does not guarantee future results. For financial decisions, always consult a licensed advisor who knows your specific situation. If you found value here, don't forget to subscribe to Jim Invests and turn on notifications. In the next video, I'll reveal the exact index funds I use, along with actual historical returns and a full breakdown of the risks and upside. Until then, keep climbing. The exponential curve is waiting for you.